It's a great moment, students. We meet for a session of advanced financial reporting and analysis. We are going to talk about International Accounting Standards 33. That is how organizations are supposed to compute for the earnings per share. So earnings per share, you need to understand how organizations compute for the basic earnings per share and how they compute for the diluted earnings per share. For the students who attended my previous live session, where we did basic earnings per share, I think you gained a lot, even if there was some few challenges here and there. Even I went ahead to record some videos. It was one video, that is, I shared to the WhatsApp group. I think you managed to check on how we do basic EPS. So today, again, I want to do a question whereby you are supposed to do basic EPS and at the same time diluted. On a scenario whereby in that question, there is incorporation of a reverse, that is a share split, not a reverse split, a share split and right issue. So remember that we said that when there's a right issue is whereby shares are issued to the existing shareholders, but the entity is not getting any return. There's no return the entity is getting. So there's no equal return the entity is getting. So that is under right issue. So under bonus is where there's no return at all. But under the right issue, the entity is getting some return, which is not equivalent to the shares which it issued. So as I can make a clarification on the two, right issue and bonus. So we say that for the basic earnings per share, we take the profit attributable to ordinary shareholders. We divide with the weighted average number of ordinary shares. We divide with the weighted average number of ordinary shares. Whereby we said that in order to get the profit attributable to ordinary shareholders, we take the reported profit after tax, we raise preference dividends, and we raise the profit attributable to the minority shareholders. So for the weighted average number of ordinary shares, we weigh the number of ordinary shares as per the time factor, So you can see from my notes here that the main objective of IAS 33 is to enhance uniformity in the way earnings per share is computed. The standard requires all companies that are listed, quoted, or those that issue financial statements to the public to present both the basic EPS and the diluted EPS. Basic EPS, the formula for the basic EPS is given by profit attributable to ordinary shareholders. So on this one, I use the earnings, which is the same as profit. So on my scenario, I would be saying profit attributable to ordinary shareholders. You divide with the weighted average number of ordinary shares. I would be using powers over 1s. The one we used last time, that is the one I will continue with. The powers over 1s. Profit attributable to ordinary shareholders over the weighted average number of ordinary shares. So the 1s, that is the one I will be using. So for the profit attributable to ordinary shareholders for the year, is the profit after tax. You raise the preference dividends. So in this case of a group, it is the profit for the period attributable to the holding company parent. If a company presents a statement of comprehensive income, then the earnings or the profit attributable to ordinary shareholders should exclude other comprehensive incomes. So without going into deeper, reading more and more, in short, what you need to understand is that for you to do the basic EPS, you take the profit attributable to ordinary shareholders, you divide the weighted average number of ordinary shares. You divide the weighted average number of ordinary shares. And then we said that for the diluted EPS, what does diluted EPS shows? So the diluted EPS, it signifies a reduction in the value of basic EPS. So according to the International Accounting Standards 33, a company is meant to disclose both basic and diluted, with the diluted EPS being a what-if analysis. So the diluted EPS indicates to the users that there's a possibility that the basic EPS will decline in the future if number of ordinary shares increases. So if there's no possibility of an increase in number of shares, then the basic EPS and diluted EPS are the same. So diluted EPS signifies a reduction in the value of the basic EPS. It signifies a reduction in the value of the basic EPS. And it's computed on the basis of what-if analysis. So I will be able to interpret more when I will be doing a question on how to do the basic and the diluted when you are given now a question. So I would like to do a question of September 2015 question. This is question 4. September 2015, question 4. So they are saying that Ocean Limited is a manufacturing company quoted on the Securities Exchange. The following information was extracted from the records of the company. On 1st January 2013, the company had in issue and outstanding share capital of 300,000 ordinary shares of shillings 20 each. 100,000 8% convertible preference shares of shillings 50 each. All ordinary shares were fully paid, and the preference shares were convertible into ordinary shares at the rate of 3 ordinary shares for every 2 preference shares fully paid. Number 2, the company's reported profit after tax of 1.2 in the year ended 31st December 2013 and 1.8 in the year ended 31st December 2014. The profit for the year ended 31st December 2014 is after inclusion of a profit of 250,000 from the operations discontinued in the period. Number 3, on 1st April 2013, the company made a right issue of 1 fully paid ordinary shares or at shilling 60 for every 3 ordinary shares when the shares were trading at shillings 84 each. Number 4, on 1st October 2013, the company issued 200,000 ordinary shares at market price. Number 5, due to high market price of its shares, Ocean Limited split its shares in the ratio of 2 fully paid ordinary shares of shillings 10 each for every 1 ordinary shares of shillings 20 each on 1st April 2014. Number 6, the company offered 200,000 stock options on 1st June 2014 with an exercise price of shillings 30 when the average market price per share was shillings 40 in the year. None of the options were exercised. Number 7, on 1st July 2014, the company issued 8% convertible debentures amounting to shillings 4 million. The debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every shillings 1,000 of the debentures. None of the debentures were converted in the year ended 31st December 2014. The company had issued 6% debentures with a nominal value of shillings 5 million in the year 2010. The debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debentures. None of the debentures had been converted by 31st December 2013. However, on 1st October 2014, holders of shillings 3 million debentures converted them to ordinary shares. Number 9, corporate tax rate was 30%. Required basic EPS for each of the year ended 31st December 2013-2014. Diluted EPS for the year ended 31st December 2014. Let us start by doing the basic EPS. So you need to know the formula that when you are doing the basic EPS, when we are talking about basic EPS, we always say that it's equals to powers over 1/2. That is, in short, I have written, which means that powers is the profit attributable to ordinary shareholders. 1/2 is the weighted average number of ordinary shares. So to get the powers, that is the profit attributable to ordinary shareholders. That is for the year 2013-2014. We start from the reported profit after tax. Reported profit after tax. So the reported profit after tax. So the reported profit after tax was provided in additional information number 2. And what you need to know is that when you are doing your basic EPS, you use profit from both continuing operations and discontinuing operations. Because checking in this additional information number 2, you can see they said the company reported profit after tax of 1.2 in the year ended 31st December 2013 and 1.8 in the year ended 31st December 2014. The profit for the year ended 31st December 2014 is after inclusion of a profit of 250,000. From operations discontinued in the period, which means that this 1.8 was inclusive of 250,000, which is from discontinued operations. There's no impact when you are doing basic EPS, because I've said for basic EPS, you use profit from both continuing and discontinuing operations. So which is okay. Our financial year 2013, the reported profit after tax is 1.2, and this one is 1.8. 1.8. Then what we have to raise is the reported profit after tax. Reported profit after tax. So the reported profit after tax. So sorry for that. Sorry for this. What we have to raise is all about the profit attributable. Profit attributable to NCI. Remember that for the reported profit after tax, that is what we started with. Then you check if there's reported, that is, if there's profit attributable to the NCI. There was none. Then we have to raise dividends to preference shareholders. Dividends to preference shareholders. Dividends to preference shareholders. So you need to go to your question and check where you have the preference shareholders. So you check in additional information number 1, you were told that on 1st January 2013, the company had in issue. So the company had an issued and outstanding share capital of 300,000 ordinary shares of shillings 20. This is ordinary. And 100,000, 8% convertible preference shares of shillings 50 each. So which means that the dividends which are paid to these preference shareholders are based on a contractual rate, on a percentage of 8%. That is the contractual rate, the 8%. So 8% of the shares times shillings 50 per share. You multiply shillings 50 per share. So that is from 2013. That is what happened. And remember that my equation is in terms of thousands. That is why you can see I'm reducing that figures. So if you take 8% times 100 times 50, I can see that is so 0.08 times 100 times 50. So that is 400. So here we have 400. That is from 2013. So we need to check if there's any change which occurred in the year 2014. If there was in any way they decided to pay. Did they make any change? In note 2, it was profit. Note 3, they are talking about right issue. Note 4, they are talking about ordinary shares being issued. Note 5, they are talking about share split. Note 6, they are talking about stock options. Note 7, they are talking about 8% convertible debentures. Note 8, they are talking about 6% debentures. Note 9, they are talking about corporate tax. So which means that the same shareholders who were in 2013 are the same are the same people who will be in the 2014. The same providers of capital, that is the preference shareholders who were in the year 2013, they will be the same people in the year 2014 being paid the same value of dividends at 8%. So up to that point, we are done with the profit attributable to ordinary shareholders, of which the first one will be 800 and the second one would be 1400. Let us go ahead and do the one-offs, weighted average number of ordinary shares. The one-offs 2013 first. So when you are doing the one-offs, you need to be careful by checking what you have in the question. That is, do you have a right issue in that 2013? Do you have a share split? Do you have a reverse split or a bonus issue? To be more specific, you need to be careful and check if you have a right issue. In our question in the year 2013, I remember very well that in a certain additional information, there was a right issue. That is in additional information number 3, as at April 2013. Remember that our financial year ends December. So as at 1st April 2013, there was that aspect of right issue. That is according to note 3. So if you have a right issue in a certain financial period, when you are computing the one-offs for that relevant period, you use this formula. So you say ordinary shares before right issue you multiply with the fair value before right issue you divide with the theoretical extract price, TERP, theoretical extract price. You multiply with the period before right issue. Period before right issue. You add the ordinary shares of the right issue. Ordinary shares of the right issue. You multiply with the period after right issue. That is the formula. Ordinary shares before right issue times fair value before right issue. You divide with the theoretical extract price. You multiply with the period before right issue. You add with the ordinary shares of the right issue. You multiply with the period after the right issue. So before, after. So what you get before and what you get after, you add. So let us do the analysis of shares to apply in that formula. Analysis of shares to be applied in the formula. So the analysis of shares to be applied in the formula. So for the analysis of shares to be applied in the formula, so you write the date, you say details, you talk about shares. So remember that our financial year starts on 1st January 2013. The balance brought down. How many shares were there from the start of the year? 300. As per note 1, how many shares were there at the start of the year? From the start of the year, 1st January 2013, the company had an issued and outstanding share capital of 300,000. That is what I've recorded. Additional information number 2 was concerning profits. Additional information number 3 is where we have the aspect of right issue. The aspect of the right issue. So that is from which date? 1st April 2013. 1st April 2013. Right issue. So the shares which were issued through the right issue are in which proportion? In which proportion? They say that in Note 3, the company made a right issue of 1 fully paid ordinary shares at Shilling 60 for every 3 ordinary shares when the shares were trading at Shilling 84. You need to understand that a right issue is whereby the entity is giving out shares to the shareholders who are existing in the entity at a price which is lower than the market price. Like now here we have 84 is the market price. The entity is giving out shares at 60, which is lower than the 84. The proportion is 1 ordinary for every 3. For every 3, 1 for every 3 which were outstanding. So the one which are outstanding are these ones, the 300. So how many shares the entity issued through the right issue? We have 100. Let's check if there's any other shares issued in the year 2013. After finishing Note 3, we move to Note 4. They are saying that on 1st October 2013, the company issued 200,000 ordinary shares at market price. 1st October 2013. 1st October 2013, the company issued 200,000 ordinary shares at market price. That is a new issue which was done. A new issue of shares of 200. A new issue of shares of 200. Let's check if we are done with 2013 by moving to additional information number 5. Due to high market price of its shares, Ocean Limited split its shares in the ratio of 2 fully paid ordinary shares of Shillings 10 each for every 1 ordinary shares of Shillings 20 each on 1st April 2014. You can see they are talking about 2014. Let's finish first with 2013. So now those are the shares we have, 300, 100, and 200. Let's apply in the formula so that we have our 1-Os in 2013. So what we do here, we take ordinary shares before the right issue, which is the 300. We have 300. We multiply the fair value, which is 84. Do you remember the 84? 84, you go to the statement whereby they were talking about the right issue. That is Note 3. Remember that they said that on 1st April 2013, the company made a right issue of 1 fully paid ordinary shares at 60 for every 3 ordinary shares when the shares were trading at 84. 84 is the fair value, which is the market price. Theoretical extract price, you do a working to get that. Theoretical extract price. You use the proportion. Remember that they are being given, the shareholders are being given 1 new share at a lower price, which is 60. But the one which were existing, the 3 old, were going at a market price of 84. Remember, it was 1 for every 3 which were existing. So 1 new at 60, that is the price at which they are issuing the right issue. 3 old at the market price. 3 old at the market price. So you multiply. So 3 times 84, I'm getting 252. So you add this. So this is 4. That is 4. 60 plus 252. That is 312. That is 312. So you take 312 divided by 4. So 312 divided by 4, that is 78. So this is the theoretical extract price. The period before the right issue is all about 3 months, 3/12, because the right issue occurred on April 1st. So which means that the period before the right issue is January, February, March. Then after that, you talk about ordinary shares after the right issue, which is the 300 plus the 100. So the 400. Ordinary shares after the right issue. You consider the one which were before plus the shares which are issued through the right issue. The one which are issued through the right issue. that is 400. Period after the right issue is 9 months, from 1st April to the end of the year. So you can see there is 300 which is remaining here, which has not been affected by our formula. What are you supposed to do with it? 200. So let's say that in 2013, you were given those shares of 200, then you are told that give us the ones. What do? You weigh them. When you are determining the weighted average number of ordinary shares, you just weigh the shares as per the time factor. That is from the time of issue to the end of the year. So you say 200 times how many months? October, November, December. Those are 3 months. So the answer you were getting from your first computation using the formula, you add with the answer from our next weighing of the 200 shares. So this is automatic 50. Then the first one, I think you can use your scientific formula to give me the answer. If you have one. So from my end, what I'm getting is my calculator, it's like it has issues. So someone to give me the answer? Because I can see my calculator is doing wonders here. What is the answer there? 300 times 84. So I can see someone is saying 430.77. Is that confirmed for us? It's confirmed. That is okay, Martin. So if you add with 50,
it's supposed to be 380 before plus 50.
So this is 380. 380.77. Then when you add 50 is when you get now the 430. And that means that it's like we are done with 2013. So we can give out the basic earnings per share for 2013, which is supposed to be 800, which is the profit attributable to ordinary shareholders. This one. You divide with 430.77. 800 divided by the answer. That is 1.86 shillings, 1.86 per share. So I can say shillings 1.86 per share. That is okay. So shillings 1.86 per share. And so let us do 2014. So let us do the one who's 2014. So in 2014, there is no right issue. So there's no use of writing the formula. We only use the formula when we have a right issue. But now when we don't have a right issue, we just weigh the ordinary shares. So you write here the dates, you talk about details, you talk about the shares, you talk about, you weigh, that is the weight, and you talk about the one-offs. So here we start from 1st January 2014. Balance brought down. So remember that the shares which were there in the previous year, first is what to brought down in the next financial year. How many shares were there in 2013? That is what we opened with in 2014. So this total here. So this total was 600. So that is for 2013, the 300, 100, and the 200. So that is what you record here. Then you weigh from this date, 1st January to the end of the year. Those are 12 months, 12 over 12. So you get 600. You get your 600. Then now we move to additional information number. We were adding to additional information number 5. Due to high market price of its shares, Ocean split its shares in the ratio of 2 fully paid ordinary shares, 2 fully paid ordinary shares of shillings 10 each, 2 fully paid ordinary shares, each going at 10, each going at 10. For every word, they say the 2 fully paid, 2 fully paid ordinary shares of shillings 10. For every 1 ordinary share of shillings 20 on 1st April 2014. 1 ordinary shares of shillings 20. 1 of shillings 20. Remember that from 2013, in simple terms, from 2013, our shares were trading at what value? Shillings 20. Shillings 20. So they are considering this price to be high. That is what they are saying. Due to high market price per share. So they want to split the shares so that they make them cheaper. That is why they are going down to make per share at shillings 10. So they are reducing the price per share from 20 to 10. So that is why you can see you are given a proportion of 2 ordinary shares of shillings 10 for every 1 of 20 each. That is why I would think that the proportion for share split obviously would be 2 over 1. My proportion for share split would be 2 over 1. And on this scenario, you need to understand that it's all about reduction of the power value of the shares, whereby they would be able to attract more investors to buy the shares. So if you split 1 share, it brings another share so that in total they would be 2. So if you split 1 share, there's another one which comes in. So in total they would be 2. So for now, by April 2014, they are doing a share split of the shares which were outstanding as at 31st December 2013, which are these 600. So this 600 will bring another 600. So it's the same way saying 600 times 2 over 1, you get 1200. You get 1200. But now already out of the 1200, we have recorded the first 600. The first 600 have been already recorded. That is why I'm just considering the 600. Then when doing the weigh, you don't weigh from the time the split occurred. You weigh these shares which you have splitted from the initial period when they were incorporated in the capital structure, which is January. So that is why I would say 12 over 12, 12 over 12. So here we have 600. You weigh the shares splitted from the initial period they were incorporated in the capital structure. For note 6, I don't have to use it in basic EPS because when I will be doing my diluted EPS, I will use potential securities. The securities which are likely or unlikely to be converted to ordinary shares. That is why when doing my diluted, EPS, I go with the what-if analysis that these potential securities, they are converted to ordinary shares. So in short, the potential securities to be used in diluted includes stock options, convertible debentures, bonds, or loan notes, convertible preference shares, and the convertible debentures. So I've talked about debentures, convertible preference shares, and bonds or loan stock. So in short, the securities which bear the word convertible, the one which are converted to ordinary shares. So specifically, they would be converted or they might not be converted. When doing diluted, we always go with the assumption that they are converted for us to use them in the diluted EPS. But these converted securities, you can only use them under basic EPS if they are specifically converted to ordinary shares. Because for the basic EPS, under the weighted average number of ordinary shares, we weigh ordinary shares, not convertible securities, not the one which have not been converted. For us to use the convertible, they have to be converted. Like in note 7, you were told that, so for note 6, I've said specifically these stock options diluted EPS. For note 7, there's a convertible debenture, but did they convert for us to use it under basic, specifically under one? They said the debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debenture. That is just a proportion of conversion. They have not said that they have converted. If they convert, that is the proportion they will use to convert. They said none of the debentures were converted in the year 31st December 2014. So we cannot use this, we can't use this in basic. Number 8, the company had issued 8% debentures at a nominal value of 5 million. Year 2010, debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debenture. That is the proportion if they convert. None of the debentures had been converted in the year 2013. That is by 31st December. Remember that this security was there from 2010. It was present from 2010. But by 2013, which means that it was there in 2013. But in 2013, there's no conversion which took place. None of the debentures were converted in the year 31st December 2013. However, on 1st October 2014, 3 million debentures converted them to ordinary shares. So we have to use now in 2014 because they have said specifically that 3 million was converted. 3 million was converted to ordinary shares. In which proportion were they converting? In which proportion? For every 60 ordinary, that is 60 fully paid ordinary for every 1,000 of the debenture. So they converted 3 million. So that happened on 1st October 2014. So the conversion. So 60 for every 1,000 times 3,000. That is what they converted. Then you need to ask yourself, remember that when there's this aspect of share split comes in, now that date is very important. April 2014 is very important. Because now any security which will be coming after the split, it has already been splitted. But the one which is becoming before the split, the one which is coming before the split, it has not been splitted. Its price is high. We need to split. Like now, this security, the 5 million, was in the year 2010. So considering that this one comes before, this one comes before April 2014. So which means that it has not been splitted. We need to split by multiplying by 2 over 1, 2 over 1. So that is 360. Then you weigh from October to the end of the year. You consider that period, October, November, December, 3 months. So this is 90. So the total here is 1290. So that my basic EPS is equals to, so my pulse was in the year 2014 is 1,400. This one. So 1,400 divided by 1290. So you get shillings what per share? That is 1.09. That is what I'm getting here. If EPS comes to your in your exam, make sure you have these marks of basic. Score everything in basic. That is where you can capitalize. Because diluted, there's a lot of work to be done there. Make sure you get all of these marks. This is very simple to score the 8 marks. Then here you need even 3. So that question of EPS would be in a better position. Then you add with the other questions, of which obviously there's 100% probability that a question of the same kind might appear in your paper. So here, we are done with the basic EPS. We go to the diluted EPS. We go to the diluted EPS. So when doing diluted, I said that why do we do diluted? And the need for the year 2014. Why am I doing the diluted for the year 2014? So diluted EPS, it signifies a reduction in the basic EPS. Diluted EPS is a reduction in value. So diluted EPS signifies a reduction in the value of the basic EPS. So the diluted EPS indicates to the users that there is a possibility that the basic EPS will decline in the future if the number of ordinary shares increases. But now if there is no possibility of increase in the number of ordinary shares, then the basic and the diluted EPS are the same. So when I will be doing my diluted, I might use, not even I might, you will find convertible preference shares. You would find convertible preference shares. You need to know how to deal with them. You need to know how to deal with convertible loan stock. You need to know how to deal with convertible loan stock. You need to know how to deal with stock options, exercising of options by the shareholders, by the employees even. They always say that the employees are given share options. So that is the main thing. I will be coming back to these notes when I will be dealing with each item. Like now, when I will be dealing with convertible preference shares, I will come and express about these notes in depth. The same for convertible debentures and loan stock and share options. So in my question, we have those potential securities to be used. Those potential securities to be used. Which are those potential securities to be used here? We have the one in note 1, convertible preference shares. Because I said under diluted, we use potential securities, the one which are convertible to ordinary shares. So the second one I will use is the stock options. The third one is 8% convertible debentures. The fourth is 8% debentures. I'm using it because they said they converted 3 million. So I'm assuming that this security is convertible because already they converted the 3 million. So let us start from the convertible preference shares. Then I explain what are you supposed to do? What are you supposed to do? Which columns are you supposed to prepare? So let's go ahead and do that. So when you are preparing your diluted EPS, the steps to follow. So step 1, you do basic EPS. Step 1, we are done with it. We did basic as the requirement. Step 2, you determine the order of ranking the securities. And that is now my step 2, which is here. You draw this table. Determine order of ranking the securities. Order of ranking the securities. So you rank the securities based on their effect to the basic earnings per share. So how does they affect the basic earnings per share? So I will be using potential securities. Remember that right now we have a potential security number 1, convertible preference shares. We have the convertible preference shares. So what am I supposed to do under the convertible preference shares? Going back to my notes, I said that I would come to express more about these notes. Going back to my notes, remember that under the convertible preference shares, in this case, the company promises to issue new ordinary shares to preference shareholders at a future date. If the preference shares are converted to ordinary shares during the financial period, then the new ordinary shares will be included in computing the basic EPS from the date of conversion. Like now, you remember the debenture. When it was converted, we included that in the basic EPS. The same way, if the convertible preference shares is converted, we need to consider it in the basic earnings per share. So if no conversion is in place, then an assumption is made that the conversion took place in order to compute the diluted EPS. That is why I was talking about the what if analysis. What if they convert? What if they convert the security to ordinary shares? So we go with the assumption that a conversion took place in order to compute the diluted EPS. So therefore, earnings are adjusted by adding the preference dividends. That is why I have my first column. You see this column of earnings. incremental earnings. Under convertible preference shares, they were supposed to pay dividends, which they will never pay because we are assuming that that security is converted to ordinary shares. And that is why I have my second column that there is incremental shares. They never paid that dividends. That is a saving they made. There's an incremental earning. So which would be based on 8% over 100 times shillings 50. So that is 400. Then what about shares? Incremental shares. Remember that this security was, we are assuming that now it was converted to ordinary shares. That is why I will have my second column, incremental shares. So in which proportion did they convert this security? In which proportion were they converting if they were to convert? They said that preference shares were convertible into ordinary shares at the rate of 3 ordinary for every 2 preference. 3 ordinary for every 2 preference. So that is 3 over 2 times 100. Then you need to ask yourself, was this security before the split or after? This was from January, which is before the split. So you have to split by multiplying by 2 over 1, 2 over 1. You need to make those shares to be cheaper because now initially they were at the higher price. So what I'm getting here is 300. So I have to divide this and this. 400 divided by 300. So that I get earnings per incremental shares of 1.33. Of 1.33. Moving to another potential security, number 2, was in addition information number 6, but now this one I will make it to be the last one, the stock options. Let me do number 7 and 8 first. So number 7, it was concerning 8% convertible debenture. Let me take you back to the notes and check what is done when you are dealing with a debenture. So this is a debenture. A debenture is like a loan stock, you know that, as an advanced financial reporting student. So it requires the same approach as the convertible preference shares. If they are converted into ordinary shares during the year, then the shares will be included in computing the basic EPS from the date of conversion. If no conversion takes place, then we assume conversion took place in order to compute the diluted EPS. We assume. The main thing, are they converted? Do they bear the word convertible? Yes. Were they converted? No. We don't use them under basic. What about diluted? We assume that they were converted. We use them. What am I supposed to adjust? Adjustments are made to earnings by adding interest, net of tax, which I say tax shield, 1 minus T. T is my tax. T is 0.3, which will give me 0.7. So under earnings, I have to multiply the interest with 0.7, net of tax. That is, and adjustments are also made to shares by adding the new shares that could be issued on conversion. Where relevant, the interest and shares will be prorated based on time. just like convertible preference shares. Convertible loan stock can either be dilutive or non-dilutive. The process of checking for dilution also again involves computing the basic and incremental EPS. So I don't want to read this because that is what I will be doing, because this is now what I will be doing in my table. So going back to the question, the interest they were supposed to pay in this security is based at 8%. You multiply with a security of 4 million net of tax. So 8% debenture, it's convertible, you know that. It's a convertible debenture. So 8% times 4,000 times 0.7. And this one, 0.7 applies only under interest. The security where the return is interest. You cannot apply under dividends. Remember that the preference shares, the preference shareholders were supposed to be paid dividends, which we never paid. That is why we have a saving of 400. So in this scenario, the saving, the interest, net of tax. In tax, you call it a tax shield. You can go and research more about what is a tax shield. So this is 224. So what about shares? They were converting in which proportion? 60 for every 1,000. So there's an incremental shares, because now we are assuming that they converted in this proportion. 60 ordinary for every 1,000. Times the 4,000. Am I supposed to split? No. Why? Because this security of 4,000 was issued after April. Anything coming after the split, it has already been splitted. We don't have to split. So 60 divided by 1,000 times 4,000. So I'm getting 240. Divide this and this. 224 divided by 240. That is 0.93. All right, the next one was the last additional information. Again, it's a debenture, but now this debenture was this debenture of 5 million, 3 was converted. So when the security is converted, you first recognize the converted, then the unconverted. So I will recognize first the 3 million by saying that it's a 6% debenture, which is convertible. So under earnings, first I will recognize, so 6% of the 3 million, that is 3,000, up to the date of conversion. That is why they said that in the notes, that is why they said that where necessary, where relevant, the interests and the shares will be prorated on time. That is what I'm doing here. So this security of 3 million was converted when? Was converted on October. So from January to October, up to the date of conversion, 9 months. So we prorate up to the date of conversion. Those are 9/12. Then net of tax, 0.7. 0.7 plus 6%. Now the balance which was never converted is 2,000. 12/12. Remember that the 2,000 which was never converted. Remember that the total security was 5 million. They converted 3 million by October. So which means that the 2 which was never converted was there from the start of the year to the end of the year. That is why I'm saying 12/12. Net of tax. Net of tax. Then for the shares, use the proportion. The proportion for conversion was 60 for every 1,000. You consider first the one which was converted, the 3 million up to the date of conversion, 9/12. Then remember that the security of 5 million was there from 2010, which is a period before the split. We need to split this plus 60 you divide by 1,000 times 2, the unconverted. You multiply 12/12. You split 2/1. So this one is supposed to give you 178.5, and this is 510. Is that true? Confirm. So divide 178. I have confirmed the figures are okay. 178.5 divided by 510. So that is 0.35. So dividing this and this. Then we finish with stock options. Stock options. So now for stock options, I want to go back to the notes again so that I make you understand what am I supposed to do there, or what as a student you are supposed to do under stock options. So under the stock options, exercising options or warrants, a company is requiring to sell at a price which is less than the market price at the future date. That is when the options or warrant owners exercise their rights. That is in terms of the shares. So if the exercise is carried out during the financial period, then in computing the basic EPS, or the shares on issue on exercise are included from the date of the issue. However, if no exercise takes place, so if the exercise takes place, obvious, we have to use those shares with the shareholders exercised to compute the basic EPS. That is what they are saying. If the exercise is carried out during the financial period, then in computing the basic EPS, or the shares on issue on exercise are included from the date of the issue. However, if no exercise takes place, then we assume the exercise took place for the purpose of computing the diluted EPS. So we assume. So what are we supposed to do now? Because in our questions, mostly, you always find that they never exercise. Like now in our question here, in that note 6, if you read note 6, the company offered 200,000 stock options on 1st June 2014 with an exercise price of 30 when the average market price was 40. None of the options were exercised. So we assume now that they exercised in order to use those options in diluted EPS. So I-33 recommends that only the bonus shares to be included in computing diluted EPS. Bonus shares are the ones which are supposed to be included. No savings is made to earnings. That is why my earnings would be 0. No savings is made to earnings. When they will never exercise, earnings is 0. For the shares, we only record the bonus. Remember that in our question, they were given an option to exercise the shares at 30. The market price was 40. So the options were 200. You multiply with 40 minus 30 is the bonus over the 40. Then you weigh from the time of exercise. So those are the bonus shares we record. 40 minus 30. 40 was the market price. They were to exercise at 30. So the difference is 10. Divide the total of 40, you multiply with 200. Then you do what? Then from there, you weigh from the time of exercise. So from the time of exercise is all about 1st June as per note 6. The company offered 200,000 stock options on 1st June 2014. So from June to the end of the year, how many months are those? 7. So you multiply with 7. So what are you getting? 40 minus 30. 10 divided by 40 times 200 times, that is 7 over 12. So from my end, I'm getting 29.17. So if you divide 0 divided by 21, that is 29.17, you get 0. Then now you rank these securities from the list, the one which has a least effect to the basic EPS. So this is the one which has a least effect. 1. Number 2 is this one. Number 3 is this. Then we have number 4. Then finally now we compute the diluted EPS. So under this, we have the earnings, we have the shares, and we have the diluted EPS as the last column. So you start from a basic EPS 2014. So the pulse was 1400. But remember this 1800 was inclusive of 250. From the operations, discontinued, of which I said when computing the diluted earnings per share, we only use profits from continuing operations. So which means that I will raise the 250 here under the 1400 direct. So I would say 1400 minus that 250 without doing a lot of processes. So this is 1150. One was 2014 was, so the one was 2014 was 1290. So you take 1150, you divide 1290, 0.89. Then now you start with the number one, the one which has a least effect to this basic EPS. That is the stock options. Stock options was number one. The earnings was 0. The shares, we have 29.17. You add the two, you divide. So here we have 1150. 1290 plus 29.17. We have 1319.17. So 1150 divided by the answer, 0.87. Number two is this one, which was 6% debenture, 178 and 510. So 1150 plus 178.5. That is 28.5. 1319.17 plus 510. 1829.17. 1328.5 divided by 1829.17, 0.73. Number three was 8% debenture. Earnings 224. Shares 240. You add, you divide. 1328.5 plus 224. 1552.5. 1829.17 plus 240. 2069.17. 1552.5 divided by the answer, 0.75. 0.75. Then the last one is number 4. The convertible preference. Remember, when even the others were convertible. It's only that I'm not writing a lot of information. Even these and these were convertible. So we have here 400 and we have 300. So this is 1952.5 and this is 2369.17. 1952.5, you divide 2369.17, 0.82. So you would say diluted EPS is equals to shillings. The least is 0.73 per share. You can see this one, these securities were signifying a reduction in the basic EPS. But these two, now they are increasing the basic EPS. So these 8% debenture and the convertible preference shares, so the 8% debenture, convertible debenture, and the convertible preference are anti-dilutive. They are anti-dilutive. Those securities are anti-dilutive. And that marks the end of the question. So for the anti-dilutive, even they mentioned in these notes of ours that just like convertible preference shares, convertible loan stock can either be dilutive or non-dilutive. And you have seen for yourself that they are anti-dilutive. If there's any question, it's open for the class to ask questions. That is for the remaining students. You were around how many students? Others have left. I assume that they are okay. They are okay with the topic. So the topic never came difficult, or it's difficult.